Hello, everyone. Welcome back to another installment of the Lunch and Learn webinar series. I'm your host, Mayur Thaker. I am an equity analyst here at Zacks Investment Research, and I also am the portfolio manager for the Zacks Earning Certain family of portfolios. And today, which is something very opportune and ripe in terms of timing, is a video dedicated to the SaaS space. And I wanted to present a little framework, if you will, for being able to select the best positioned companies within the software as a service complex. So this video is dedicated to thinking through the SaaS opportunity, a framework for selecting the best positioned companies. So let's get started. So as we all know and have heard by now, there are three or four frontier LLMs is what they're called. These are the largest and most advanced AI models that are available. And these four frontier models are OpenAI, Anthropic, Google's Gemini, and xAI. And as a combination between these four, all of which operate slightly differently in different areas, but overall, together, these four plus a number of upstarts that are built on these frontier models are collectively threatening software, the traditional software space as we know it. And large language models have now at this point become so advanced that they're able to execute both mundane and repetitive tasks as well as complex workflows. What once required hundreds of programmers and millions of hours of work is now being executed in less than a tenth of the time and the labor needed. So AI models are still only as good as the data that they're trained on and the strength and thoroughness of user prompts. So, up until now, right, these LLMs, these AI assistants were precisely that. They are assistants, meaning they have access to enormous amounts of data and are trained on logic and thinking through different complex questions or instructions. But at the end of the day, they remain um, assistants, meaning it still depends on you, the user, to prompt it to think in a certain way and to push it into a certain direction in order to generate a response. So, these LLMs are great as assistants so far, thus far. However, agentic AI is sort of the next wave, which replaces the need for humans to think and guide the AI query. So the software begins to use logic independently beyond the original prompt to ultimately arrive at a final destination. That's where all of this is ultimately headed. And because of that, right? Remember, OpenAI, Anthropic, Google Gemini, these have been around for several years now. Anthropic actually was founded in 2021. OpenAI has been around since 2018 or 2019, and it got, really advanced. It started turning heads about 2 years ago, actually 3 years ago in 2023. So it's been a while since these services have been out, but it's only now that the SaaS space, the traditional vertical software space, has come under serious pressure. And that's because agentic AI is sort of the next wave, where these, LLMs, these AI applications are, for the first time ever, able to generate queries on their own, um, going from step A to step B, C, and D without needing handholding or guiding at each step of the process. So that's why, the SaaS space has come under severe pressure only now in the last several months. So agentic AI upstarts will threaten legacy software in basically two different ways. And this is just my view, my opinion. It's not necessarily the opinion of Zacks, but or exactly how it will play out, but in just my basic way of thinking through what this really means is that, legacy software companies are going to be impacted in two ways. Number one is that AI upstarts using either frontier or advanced LLMs will build apps that provide highly capable alternatives at a lower price. So it's very straightforward. You have, existing software applications, and then you have AI upstarts that compete with existing software applications. And usually what that means is that it drives prices down in a commodity sort of area. Or, what was once a monopoly or an oligopoly is all of a sudden that those advantages are competed away with AI. So that could happen as one scenario. The other scenario is that chief information officers at large and medium-sized firms will start giving serious thought to developing in-house software to replace expensive subscriptions. So either, outcome is obviously very bearish for entrenched legacy software companies who, have historically provided value uh, primarily through user interfaces, UI. But if what they're doing fundamentally is based on publicly available data or easily purchasable data, then AI upstarts are going to be able to compete away that advantage that these companies used to enjoy for years, for years and years. So that is why, I've created a three-step framework for assessing the durability within the SaaS complex. Um, this is my sort of mental model, if you will, in going through the motions to basically understand whether a company within the SaaS space is durable or not. And the first question, right, the first step of that, three-step framework is asking the question, is it irreplaceable? That is a very, very important question. How do we know whether something is replaceable or irreplaceable? I've identified three basic qualities here. Number one is that, that software provides a critical need, right? It serves a mission critical business process or a mission critical, data. Um, it is deeply embedded into workflows. That's quality number one. Quality number two is that there are high switching costs. These are, sort of hints that you might get in order for us to understand whether a software service is replaceable or not. So, does it serve critical needs rather than discretionary or nice to haves? Is the software deeply embedded into workflows? Are there high switching costs involved? Switching costs can be in the form of time or money or both. Remember, switching costs can be because, say, for example, an organization has employees that have been using a software for many years, and that software has a very high learning curve. And if you were to switch to an AI upstart that might be cheaper, but have a similar learning curve because of the complexity of the workflows that are required to do it, uh, then that is a high switching cost in the form of requiring many months to retrain employees to use the new to use the new user interface. So there could be high switching costs in terms of the time needed to transition employees to using the new software, or there could be just simply high costs of migrating enormous amounts of organizational data into the new environment. So these are all sort of in the realm of high switching costs. And then quality number three, which is very, very important, is there proprietary data involved? So, even if switching costs are low, um, if there is proprietary data involved that you would lose if you move to an AI upstart that might be cheaper, then that is a trade-off that companies may not be willing to take. So these are three major qualities that I would say, you want to, check off at least two of these, different qualities that I just listed out here. Does it serve a critical need? Is it deeply embedded into workflows? Are there high switching costs? Or is there proprietary data involved? Does the company provide proprietary data? I would like to see at least two of these four checked off in order for us to say, yes, it is irreplaceable. Number two, is it AI capable, right? Because remember, um, irreplaceability is one thing, but does that mean that customers are actually happy with its ability to keep up, with the pace of innovation out there? So, are they moving at a similar speed that the AI upstarts that are providing the competition are moving at? So, is AI improving product competitiveness? Is AI driving R&D productivity for their clients? And as a result of that, does the company have rising or stable operating margins? Remember, this is an important piece of whether the company that you're assessing within the SaaS complex is able to survive pricing pressure, right? Because, say for example, AI alternatives drive prices lower. But if the company itself, if the software company itself is leveraging AI as well to drive greater productivity, then they may be able to offset the pricing pressure with their own organizational efficiency gains, which the net effect of that would be rising or at the very least stable operating margins. So we'd like to get some evidence from EBIT margins to see, are they rising, net of any pricing pressure, or at the very least, are they stable? So these are all things that I would like to look at when assessing software companies. Is it AI capable? If so, do we see the net effect of that, which is in the form of rising or stable operating margins? And then number three, does it have pricing power? Again, very important. Number one is a big chunk of the revenue coming from recurring enterprise-wide license revenue. Okay, this is going to be very important. Why? Because a lot of software companies, a lot of SaaS companies are dependent on user licenses. Remember, if you are dependent on the number of seats at, your client site, for revenue, what that could do in the future is put revenue at risk because in an AI powered world, ostensibly, your clients are going to have a smaller workforce, right? Um, you could see a situation where, companies opt for, going leaner with maybe 5 to 10% workforce reductions across the board. Um, that would reduce the number of seats needed in the first place, which would then put pressure on revenue, margins, and ultimately earnings for the SaaS company in question. So, in order to mitigate this, we want to focus on companies that are not dependent on user, the number of seats that they sell to their clients. So, we want to opt for companies that have recurring enterprise-wide license revenue, meaning, they sell a single license to their client regardless of the number of users that they have. There are companies that do this. Or number two, Um, they have fixed enterprise contract revenue and or variable revenue by data usage, not by user, right? So some companies can benchmark fees based on throughput rather than by the number of seats that they sell. And in an AI agentic, AI world, throughput, basically data usage is only going to go parabolic, if anything. So users, physical human users may be at a standstill or maybe in decline, but data usage or throughput is going to double, triple, quadruple over the next several years because data is consumed very rapidly by LLMs and AI agents. And so if you have a company, a SaaS company that build their pricing model on fixed enterprise contract revenue and variable by data usage or throughput, that would be a major check mark, for this third, um, step that I have here. So we want to assess replaceability, how durable it is in the area that they operate in. Is it AI capable? Are they utilizing and riding the coattails of AI to improve their own product competitiveness and driving their own internal corporate productivity higher, right? So this is all very, very important things that we want to make sure these companies are actually actively doing. And then number three, does it have pricing power, right? If it's irreplaceable, they will have pricing power. However, even if it is irreplaceable, if their clients have experienced a decline in the number of users that are using their software, right? Then even if the company is providing a service that is irreplaceable, even if the company is leveraging AI, um, you might still have revenue and earnings pressure because the number of seats are going down. So that's why the third and final step of this three-step process is we want to focus on companies that primarily generate enterprise-wide license revenue and have variable revenue by data usage or throughput rather than by the number of seats that they sell. So, companies with the greatest durability will satisfy all three criteria. So let's take a look at who these companies are. Um, who in that SaaS space is at high risk, moderate risk, and or low risk? And here is a list of the companies, a short list of software stocks, SaaS companies with ARR that I believe have the highest durability based on this three-step process. And you can see that the biggest giants, the 800-pound gorillas, are Microsoft and Google. However, in this presentation, I'm not going to go into Microsoft and Google in terms of their business model and use case, just because they are obviously the biggest companies out there that own two of the four frontier, LLMs out there. I just wanted to put them on this slide just because they do check off all three of the boxes. So owning Microsoft and Google are sort of a foregone conclusion when it comes to investing in high durability SaaS, software companies. But I just wanted to mention them here, but I'm not going to go do too much into depth. Microsoft, I will say the one thing I will say about Microsoft is that, because they do check off, all of these three boxes, and at the same time, their shares are down roughly 30% now from the highs. I think Microsoft is a no-brainer at the current price. So that's why I wanted to throw them into this slide as well, even though I'm not really talking much about Microsoft in this presentation. But I believe all of these companies, as a whole, are currently very attractively valued because SaaS as a whole has gotten thrown out together, no matter how durable they are. And that's why I believe this has opened up a significant opportunity to own some of the highest durability companies out there that will not be disrupted by AI, in my view, but will actually be enhanced with AI because AI is going to sit on top of each of these different software services, but have a very, very difficult time replacing them. They also, I believe, have, very strong pricing power as well because of the way that these companies are structured. Their revenue model is structured. I think that they are, bulletproof in that sense. And because all of these stocks are down anywhere between 20 to 40%, um, I think that they are a no-brainer to be buying, right now. So let's go into a little bit of depth into each one of these that I have here. Palo Alto is the first one. Palo Alto, well-known cybersecurity company. They make next generation firewalls. They also do cloud security and security analytics. Obviously, that is a critical need. So they are irreplaceable in my view because cybersecurity is a critical need. This is not a discretionary spend by enterprises. This is a required business expense. There is a very high switching cost involved. That's why, these companies, when they pick one company, they stick with them for many years. They have, very, very high customer retention rates, and partially because of the fact that they serve a mission critical need and also have a very high switching cost. They are AI capable. Cortex Copilot is the name of their service, is an AI driven capability. And they have, pretty strong pricing power because they will defend themselves with AI as a premium offering. So, a lot of this revenue is site-wide. It's not really as much dependent on individual users. Again, that's the reason why they do have very strong pricing power, in my view. The next company I listed out there was CrowdStrike. CrowdStrike is also cybersecurity. They're a little bit differentiated from Palo Alto because they're not as much into physical firewalls as they are in AI native endpoint protection. They are, primarily cloud native, sort of, they call them endpoint detection and response, EDR, protection. So this is cloud native, and they, at the very core of what they do, utilize AI and machine learning as a core value proposition of their Falcon endpoint security product. So again, this is a irreplaceable company because they do serve a critical need. They have a very high switching cost, and they also have a massive, very massive data moat and very large network effects. If you recall, a couple of years ago, CrowdStrike had a outage. This was, I think, in 2024, I believe. And the entire world kind of was brought to a standstill for a day or so. Um, that really proved how deeply embedded CrowdStrike is all over the world. Even Microsoft applications, many of them use CrowdStrike. That's why a lot of Microsoft-driven applications were down that one day in 2024, if you recall. So CrowdStrike, I believe, is deeply embedded. They and their service, I believe, gets better and stronger as the network grows. So I believe that this is a company that has significant network effects too. So I believe, in an age of agentic AI, where, over the next 5 to 10 years, you may have billions of agents, AI agents, running all sorts of queries on the internet. Um, and in that sort of scenario, cloud and AI native, endpoint protection is only going to be needed even more, if anything. So I think that this is a very, very durable business. Um, Pricing for the most part is at the enterprise level. Agentic AI, like I said, is actually a demand lever. So I think that CrowdStrike, cruises through all three criteria that I laid out in terms of durability. It's irreplaceable, it is AI capable, and they do have strong, very strong pricing power. Checkpoint, another cybersecurity play. They make network gateways. They also make firewalls, kind of like Palo Alto, and also do cloud security. They are a little bit on the lower end of the pricing point, so they do serve, medium-sized businesses mostly. But because of that, they do serve a very critical need. Again, high switching costs. Cybersecurity is a non-discretionary business spend. Um, they also do have AI integration into cloud firewalls. Pricing is more reliant on throughput. So that again is a very important thing, a characteristic that you really want to look for. Pricing should be dependent on fixed enterprise pricing and variable pricing based on throughput, um, and less so on a per seat basis. So again, Checkpoint is another favorite of mine. Snowflake is a big favorite of mine. This is a fascinating company. They recently went public just a few years back. They are a cloud data storage and management system. Very large enterprises are utilizing Snowflake as the system of record, essentially. Systems of record are basically a centralized location where you can pull records, you can pull historical data on your organization. You have records of everything that has been ever been done. It is a central database management solution. An organization can upload all of their data, all of their history, all of their sensitive data to the cloud. And Snowflake has creative ways of organizing and structuring that data so that it makes it very easy to query data and bring it back down for analytics and efficiency management. So this is a major system of record. At that point, when you have enormous amounts of organizational data all in one central location where it's, very easily queried, there is a high switching cost involved. There is, deep workflow integration. So because this is a centralized place where data lies, AI agents will sit on top of Snowflake and rely on Snowflake, but not replace them, right? So any place where data is stored and organized and queried, AI agents are going to need to query Snowflake. And so any AI agents are going to be downstream from Snowflake, not as a replacement to Snowflake, in my view. And again, they do have pricing power because of enterprise-wide fixed license revenue and pricing based on throughput. So again, a very, very top selection in my view. ServiceNow, this is the IT help desk, customer service management, HR case management company. Again, like Snowflake, they are a major system of record, not as a centralized database um, for the company, but because they have ticketed history um, between IT help desk and customer service management. Remember, companies a big part of their process is customer service, and ServiceNow is a centralized location where all customer service inquiries and tickets are stored and saved. So this gives you a gold standard record keeping system so that you can easily go back and check when certain issues were resolved, when certain issues were raised, things like that. This becomes very, very important, for companies across the board. And so because of that, there is a high switching cost and deep workflow integration. Again, this makes ServiceNow, very much irreplaceable. ServiceNow was literally built on automation, right? So again, AI agents will only assist that further. So this to me is a company that may not be as easily disrupted by, AI as the market currently fears. Pricing power, individual seat license revenue is significant. So this is one thing about ServiceNow that I don't really like. Right now, individual seat licenses are a major driver, a major component of total revenue, a major component of ARR. But this is slowly changing to throughput. It remains to be seen whether the company can effectively replace the individual seat license revenue model with a throughput or data usage model. Um, but that process might be slow. So pricing power for ServiceNow is the one question mark that I would put on there. However, the stock is down quite a bit, so some of that concern may be priced in by now. And especially because you have these two other boxes checked off, it doesn't make the company as big of a concern. Because again, if you are a major system of record with high switching costs and deep workflow integration. If you are AI capable and deliver automation and therefore ROI to your customers, then pricing power is not as important, but it is something to be, aware of. But because the stock is already down quite a bit, 20 or 30%, I believe, from the all-time highs, some of that pricing pressure that they might experience, I believe, is priced in. So ServiceNow, I think, still is a good investment, just not as strong as the other ones that I mentioned there. And then here we have Viva. Viva is a cloud, platform for regulated content data compliance workflows for the pharmaceutical industry. Pharmaceuticals and life sciences, companies, they rely on Viva to run clinical trials, manage regulatory submissions. So Viva, I believe, is very strong in terms of their irreplaceability. They have a wide moat system of record for highly regulated pharmaceuticals. They have significant level of proprietary data, very high switching costs as a result of that. Um, and Viva AI launched in 2025, so they are AI capable. This provides shortcuts, across every Vault function. Viva Vault is what the product is called. And 125 clients are now using that AI functionality. Now, kind of like ServiceNow, Viva is also a little bit sensitive to pricing because a big part of their revenue does come from individual seats. But that impact, I think, will be partially blunted by upselling clients with native AI agents. So, like sort of ServiceNow, I think that some of that pressure will be offset with, Viva AI, because these companies are so deeply embedded with Viva, they may opt to buy, Viva AI to be able to query and quickly perform tasks within the Viva overall platform. So some of that upselling, may be blunted. Some of that pricing pressure from potential loss of seat licenses may be blunted with upselling their own, native AI agent called Viva AI. And then lastly, we have CoStar Group. CoStar is actually one of my favorites in this entire list. Um, this is a commercial property database and analytics, software company. This is used by commercial property brokers, investors, and REITs and lenders as well. That's a very critical part of it because, again, lenders actually depend on the proprietary data that CoStar has built over decades in order to underwrite loans to commercial property investors and REITs. So this is a significant proprietary data analytics supplier, and as a result of that, there are high switching costs. There's also quite large network effects, again, because lenders rely on CoStar data and analytics. It becomes incumbent upon investors to also be using CoStar data and analytics because that's what lenders are using to get the loan approved in the first place. So, the more the number of people that use CoStar, the stronger the product becomes, and the harder it becomes to switch out of it. And so that's why, CoStar dominates this field of commercial property, software analytics. And they are absolutely, on top of the AI game. They've already partnered with Azure OpenAI. They've already leveraged GPT-4 models that are built on top of their proprietary databases. So this is very, very significant. The only thing that, again, similar to ServiceNow and Viva, there is a large component of revenue that comes from per seat pricing, but I think that they can pivot to fixed API access fees quite quickly. They've already started doing this. Management has already started talking about switching to giving a enterprise-wide license revenue structure and a fixed API access fee. So those would be just two sort of add-ons, two primary add-ons. One which is the entry-level enterprise license, and then an API on top of that. I believe that will go a long ways to offset any pricing pressure from loss of users at their client sites. But I think CoStar overall checks off basically all three of these boxes for that reason. A very, very impenetrable moat um, with significant levels of proprietary data. That is a major part of this entire thesis, actually. Proprietary data um, is valuable because of the fact that you can't get that data anywhere else. And if you have lenders that are relying on that proprietary data, yeah, all bets are off that this is a company that's going to be disrupted by AI anytime soon. Now, let's talk about two higher risk plays with possibly lucrative returns. I'm thinking Workday and Adobe. These two companies have gotten slammed. Both companies are priced for significant disruption to growth and margins. They currently trade at historically low PEs, but I believe that if they can hold off the AI threat, the upside, in my view, is significant. Just take a look at the PE multiple of these two companies. Workday is a little bit more recent in terms of their publicly traded history, but Adobe has a long, long history, many decades of a history. And here you can see Adobe now trades at a 10 PE, a forward PE of 10. Workday trades at a PE of 12. Both of these numbers are historic lows for each company, respectively. You can see Adobe really just rarely trades at a PE this low. It's currently at a 10. The lowest it really ever got was a 12 during the Great Financial Crisis, a 12 really back here in the late 90s, and currently it's at 10. Workday similarly, it's never in the last 3 years that it's been a publicly traded company, it traded at much, much higher multiples between 60 to 100. And now Workday is at a 12.5 PE. This is both companies are priced for significant disruption. Remember, a PE multiple that low basically tells you that growth is coming to a standstill. That's the market implication. When you trade at a PE of 10, usually the rule of thumb is when you trade at a PE of 10, you're growing at roughly GDP. That's been the time-tested sort of rule of thumb. A PE of 10 means that you're basically growing at GDP. And so basically what this means is that both companies are being priced for GDP growth at 2 to 3%. So the question is that realistic? Because if you look at Workday um, is the system of record for HR, payroll, and corporate finance. They sell multi-year subscriptions that sit at the core of customers' people and financial operations. It's also a workflow service for processes like hiring, right? We see Workday all the time. You look at any job posting, even on LinkedIn, when you click onto job postings, you'll see that these jobs are hosted by Workday because HR usually outsources, um, personnel management and hiring to a to a process like Workday, which then does everything from posting the jobs to fielding candidates to even using AI today to vet candidates. And then submitting qualified candidates to the hiring company. So the significant numbers of HR departments rely heavily on Workday for running these types of processes like hiring, even performance reviews, payroll, and budgeting and forecasting for corporate finance divisions of companies. Switching costs are also significant. Large implementations, could take months to migrate data and redesign processes. Workday is exposed to AI-driven seat compression, but its deep process and data embedment, plus the ability to pivot towards AI and outcome-linked pricing, likely allows it to preserve a significant degree of pricing power, in my view, I think. Though with more scrutiny on ROI and potentially slower like-for-like ARPU growth in a fully agentic scenario. So again, remember the base case is slower growth in a fully agentic scenario. But at just a 12 forward PE, the implied earnings growth rate is just 1 to 3%. Like I said, GDP growth rate over the next decade. And remember, management just recently guided for 13% growth this year. They're currently in fiscal year 2027, but that's calendar year 2026. They're guiding for 13% growth this year. So, the question is it likely that earnings are going to slow to 1 to 3% over the next decade? I think this is unlikely in my view. I think ultimately it's going to settle somewhere in between, maybe 5 to 6% growth over the next decade, maybe not quite 13% that they are guiding this year carried throughout the entire decade. But even if they just do 5 to 6%, remember the repricing of that can be very violent. A 12 PE for a company that is this deeply embedded in HR workflows, um, I believe that the base case right now, if you were to buy Workday today, is that they are about to be significantly disrupted and growth will be blunted to just 1 to 3% over the next decade. So the question is that if you think that they can beat that growth rate, then Workday is a significant buying opportunity at today's price. Same thing with Adobe. Adobe, for those that are familiar, they are deeply embedded um, in marketing departments, in creators, in artists, computer artists. The company is, broadly divided into three subcategories. The Creative Cloud that includes, iconic softwares like Photoshop, Adobe Illustrator, Adobe Premiere, that's for video editing, After Effects. This is, software bundle that has been, deeply, deeply embedded in creators' workflows for decades now. There's also the Document Cloud. This is more deeply embedded in corporate workflows for Acrobat and PDF services for creating, editing, e-signing, and automating document workflows. This is also very, very important for document security as well, for protecting sensitive documents at organizations. And then there's the Experience Cloud that provides marketing, analytics, personalization, and customer data platform tools for enterprises. And then, what are they doing to battle the rise of generative AI? Firefly is Adobe's answer to generative AI competition and is integrated into basically every part of their Creative Cloud and Document Cloud too. Sorry, Firefly is embedded in Creative Cloud, and the Document Cloud has a similar, um, AI application that sits on top of that, for very quick querying as well. So pricing power has been challenged by AI upstarts, but remember that has been largely priced in my view. Remember, the stock trades at a PE of 10. This means that significant disruption is already priced in. So if you were to back into the growth rate, right, that's implied at today's valuation, Adobe is priced for earnings growth of just 1.5% over the next decade, versus management's guidance of 9% this year. So again, what does this mean? Adobe is already priced for disruption, but if AI upstarts fail to derail Adobe's net income growth profile, Or if it's much slower at doing so than feared, then significant upside in the shares is likely from today's levels. So I hope you guys found this helpful. I'd love to hear any feedback, any questions from you guys. Again, these are the companies that I think are, great buys right now. These are companies with very high durability. These companies are going to thrive in an AI world. Um, these are companies with very strong, deeply embedded workflows, proprietary data, high switching costs, and ultimately, provide a service or product that is, fundamentally irreplaceable by AI, in my view, and companies that also have significant pricing power. And so because these shares are down, somewhere between 10 to 30%, I think these are tremendous buying opportunities right now. But if you want, more risk, bigger reward, and I'm talking about, potential a doubling in the stock price over the next 1 to 2 years, then take a hard look at Workday and Adobe. If AI is, if the threat of AI is overblown for these two companies, if they can beat the implied growth rate, which is, somewhere between 1 to 3%, let's just say 2%, if they can double it to 4 to 5%, then I think Workday and Adobe are both a 2x in 2 years. Again, this is the reason for that is because of how cheaply these stocks are priced right now versus the reality of what might unfold over the next 2 years. So these are obviously much higher risk because they do things that are going to be um, the direct sort of object of agentic AI to disrupt first. But if the threat is overblown and if they can grow faster than what is implied in the valuation today, then I think that these two companies could very seriously double in 1 to 2 years from now. So hope you found this helpful. I'd love to hear any feedback, any questions. Please do reach out to us at 1-866-794-6065 or send us an email at researchdesk@zackspro.com. And hope to hear from you soon. Take care, everyone, and hope to see you soon on the next one. Take care.